Hey everybody, and welcome to the School of Market Studies YouTube channel. And today we are going to start with a new series on the markets called Daily Market Learnings, in which you will learn to trade and invest in the markets in bite-sized capsules. And I, Vineet Bolinchkar, am going to be your host. So let's go ahead and see what Daily Market Learnings is all about. So what is Daily Market Learnings all about? Daily Market Learnings is your go-to uh, go-to platform where you will get bite-sized yet powerful learning capsules to help you learn about the markets in a jiffy. So what are all the things that we will be covering in the Daily Market Learnings? You'll get daily lessons on fundamental analysis. We'll have screeners to shortlist stocks. We'll be doing forecasting, valuing, and doing peer valuation. There will be lessons on technical analysis for learning the targets, setting the stop losses. And if you are in the mood to leverage, then welcome to our derivatives and options trading strategies module. These are based on daily market action around corporate events and news flow that occurs in the markets. So today we start off with lesson 1, and that is how to estimate the potential of a market. So if you were to gauge what your stock will be doing, we all the time are referring to what the index levels are and how the index is expected to do, isn't it? So betting on your stock is also a function of how much the market will do, right? And if you are able to encapsulate or even estimate how much a market can move up and down and what would be the range for the market, it would set the right tone for your investment strategy. So if you're at the lower end of your estimate range, then you would be looking to buy the markets. And if you're at the upper end of your estimate range, then you would be wary of taking any fresh long positions in the market, since you have very compelling information. Setting the levels for the market or estimating the potential of a market. We will take the example of Nifty, and you can even apply to any stock. But in this example, we will look at how Nifty is to be traded. So currently, we take the level of Nifty, which is around 10,400. And next, you get the earnings estimate for the next 2 years. Now, these earnings estimates are not difficult to get, and your broker or any investment journal or even an online data source can provide it for you. So if you see this chart, we are talking of the Nifty EPS. We will get to the full definition of EPS in a moment, or which is known as the earning per share, and how it is calculated we'll just see in a moment. But before that, stay with me on this. You will see that the earning per share of Nifty in the calendar year, that is from January to December 2008, was 260 rupees, and 2009 was 221. 2010 we had a bumper year where it jumped up 39%, and since then it has been growing plus or minus single digits, and barring for the year in CY15 and CY16 when the index has grown at -10 and +5, very low growth rates, okay, we have seen a jump come about in CY17. So if you notice, you can clearly see 3 different growth rates emerging out here. One is a hyper growth of about 40% because the market had tanked 15% a year earlier. Then you had very subdued growth of 9, 6, 10%. And then you've had a moderate growth of 17%. So typically you can see a very high decibel number, a moderate number, and a very low base. Now, ever since Modi came to power, the markets have been in a very, very kind of a measured move in the markets. And especially for the last 2 years, CY15 and CY16, we had, and even 17, we have seen slowdown in the economy plus the double whammy effect of the GST and the demonetization, not leading to much growth in the markets. And these numbers, so if you see over the year 15 to 17, the market EPS has grown at a compounded annual growth rate or CAGR of 11%. And over the next 2 years, analysts are forecasting a 22% growth. So EPS is expected to move from 469 to 600 and then to 700 in CY19. Now, why would I take 2 years to forecast? Do you invest for 6 months? No. You typically tend to invest for a year and little above that, right? And so as to maintain our investment horizon and give our investments room to breathe, we have factoring 2 years earnings to get our growth targets, right? So every time we discuss now, we will be talking in terms of 2 years. But before this, let's go and see the definition of what EPS is and how do we arrive at that. So EPS is nothing of the total but the total net profit divided by the total number of shares, right? So if there are 50 stocks in the Nifty, okay, so we take a cumulative profit after tax figure of all these 50 companies and we divide by the total number of shares of each of these companies cumulated together, and the total net profit divided by the number of shares gives you the EPS or the earning per share. It essentially means it is the profit per share of the Nifty, right? Now let us understand the concept of PE. PE, or the price earning multiple, is nothing but the CMP or the current market price divided by the EPS, where you get the price earning multiple. But more of this a little later. Now, getting back to our earnings estimates, you will notice that the CY18, which is the current year earnings, is typically in the parlance of the analysts known as the 1 year forward PE, EPS, and the multiple that you get, the PE, is known as the 1 year forward PE. And similarly, CY19 numbers are known as the 2 year forward multiple or the 2 year forward EPS. In this presentation, as I said earlier to you, we will be working with the 2 year forward multiple. So what does the PE ratio tell you? It tells you the current demand for the market, and a high PE essentially means that the increasing demand is happening there and vice versa. So if the PE is low, it will talk to you about supply in the market, and a low PE will mean there is a low fascination for the stock of the underlying, that is the Nifty. As I said earlier, typically we estimate for 2 years as it gives time for the market to recognize growth and factor it into price. So if you notice in this little box that we have highlighted, as spoken earlier to you, you will notice that the market moved, as I said earlier, in 3 different kind of growth rates. One was a hyper growth close to 40%. Another was a moderate growth about 17%. And then we've had lackluster growth from negative to low single digits, right? So essentially, when you are forecasting, we will take these 3 growth scenarios, and along with this, we will take 3 sentiment scenarios. Okay, but before we get to the sentiment scenarios, that is the PE scenarios, let us see what the growth scenarios suggest. Okay, so what we have done is that for CY19, as I said, 2 year forward, we have built a base case which is a normal growth rate. Then we've considered a hyper growth rate, which is the bull case. And we have taken a very, very pedestrian kind of growth, so which we call the bear case. Okay. So multiplying these by different percentage growth, we are getting on this 469 growth rate number for CY19, EPS of 524, 565, and 706. This is in comparison to the global estimates of analysts of 700 rupees that the analysts are currently factoring in. So once again, what we are saying is that there would be a moderate growth rate of around 11-12%, giving you 565 earning per share, a low teen kind of growth, which will give you a 524 kind of growth, I mean single digit growth, and a bull case scenario, which is very much in line with the analyst estimates of 706, right? So if the market were to perform as it did in 2017, then if you're expecting that, then you would be factoring a bull case scenario of 706 rupees earnings. If the market were to do a 15 kind of growth rate, FI15, then you'd be seeing a 565 kind of growth. And if you're factoring in a very, very bad scenario, then we are looking at earnings growth of around 5 to 6%, giving you 525 rupees. Along with this, so as we said, there were three scenarios depending upon the growth rate of the economy. Then we could have three sentimental impacts playing out in the market, where you have an extremely bullish sentiment, you have a very, very morose sentiment, and you have another sentiment which is around the normal. Okay, so we have given three different P's to that: 15, 19, and 23, where 15 is a morose kind or the doomsday kind of prediction. 19 is a very relatively average P of the market, and 23 is the hyper bull market kind of scenario. So we are building in a matrix of 9 outcomes and see how they look. But before that, how do you determine the market price of the Nifty? Well, just the way that you calculated the EPS and the P, multiplying the EPS and the P will give you the market price, right? So three outcomes for the EPS and three outcomes for the P gives you a binomial nine outcomes. And this is how they look. So how do we arrive at this? So in this case, we just multiplied 524.5 by 15 to get 7868. We multiplied 524.5 by 19 to get 9867. And 524.5 by 23 to get 11833. So on and so forth for the other two row columns too. And now comes the estimating part. So how do you know which of these 9 outcomes are going to be our target range? So to be one of the fastest growing economies, and often people are saying that Indian growth should outstrip China. In that case, what are we talking about? A hyper growth market. And if that were not to happen, since the bad news of the demon and the GST is well out of the way, and we are in for a good monsoon season this year, we should have a relatively a good market. So the possibility of the growth being subdued is low probability, whereas the probability of having average growth to a high growth is a higher probability event. So we take two outcomes, the base case and the bull case, into consideration. And we could even expect a hyper bull market in terms of sentiment. But taking into the consideration the kind of profit booking that is coming in, the global cycle where oil prices are rising, interest rates are hardening, and general political uncertainty of what 2019 has in planned for us, we would refrain from taking a optimistic sentiment kind of analysis. So P multiple of 23 is omitted, and we are left with a average market multiple of 19. Okay, we do not see a doomsday kind of scenario, so we are not factoring in a 15 multiple for the market, and hence we are left with but two options. That is a range for the market of 10,619 and 13,265, which means that from these current levels of 10,300 odd levels, over the next 2 years, the market should be ranged between 10,619 and 13,265. And these kind of numbers look good until September 2019, since markets tend to factor in the CY19 results much earlier into price. So anywhere between the period of May 2019 and September 2019, we should see the markets settle into that range. And this is how we would be forecasting the levels for the Nifty. In case you feel that the global market sentiment is going to turn bad and that India would not be spared, then what would you do? These same 9 numbers where the growth forecast is there, obviously you will take it in the direction of the lower sentiment PE and the bear case or the base case scenario, and you would get your estimate. The same can be worked on with stocks to get a more realistic pricing for your investments based on the market sentiment prevailing. Now, it is just not enough to compare one beautiful girl. How do you know a girl is beautiful? Well, beauty is all relative. So we need to consider more damsels. And before we get to comparing damsels, we need to introduce 2 to 3 more terminologies, which is called a return on equity or ROE. And that is nothing but the total net profit divided by the net worth. And how do you get the net worth? It is nothing but the equity capital plus the accumulated profit, right? So all the equity that has been raised and all the profits that have been accumulated over the years are taken together to get the net worth. And we introduce to you one more indicator called the PEG ratio. Hold on, this is the last one of them, so don't be kind of awed by the number of terminologies that are coming your way. So PEG multiple is nothing but the PE or the price earning multiple divided by the earnings growth. And since we are taking a PEG multiple for 2 years, hence the PEG ratio is nothing but the PE of CY19 divided by the 2-year earnings CAGR, right? And how do you know you are buying the right market? As I said earlier, it is essential that we do a peer comparison of the beauties, and in this case, the beauties are the global indices. And what we have done is we have charted the ROE on the y-axis with the 2-year PEG on the x-axis. And we've considered all the beauties of the world, that is the beautiful indices of the Dow Jones, Nifty, the Brazilian markets, the BRIC countries, that is Moscow, Shanghai. We've taken Hang Seng, Nikkei, and also the European FTSE. And if you notice, there are a large number of stocks which are bunched together, or markets which are bunched together. So we have Nifty, the Bovesa, Moscow, Shanghai, and the Hang Seng, all growth markets in a tight spot. And if you notice between them, Nifty, which is the blue shining light, has got a higher return on equity than either of them, in spite of the fact that the growth multiple, the PEG ratio of all these stocks is around the medium level. So if you were to gauge between Moscow, Shanghai, and Nifty, I would go with Nifty because we are almost on the same vertical bar in terms of the PEG ratio. and we have a higher ROE. So the quality of earnings of our market is much better. And if you would like to know what this dotted line indicates, well, a PEG ratio less than 1 is considered attractive, and markets which quote at a PEG ratio greater than 1 are considered to be very expensive. So FTSE is a very, very expensive chick to look onto. So we leave her out and we go with the Indian beauties. That's all, folks. So if you think that this presentation made your day, you learned a lot, then give me a thumbs up. And if you feel that you have not understood a lot of the things that I have told you, don't send me brickbats. Send me comments in the down there, and I will respond to you with a lot of patience and with a lot of great love and affection to make sure that you understand everything and you are well equipped to trade the markets to your satisfaction and you make a lot of money. So I'm signing out today and I will see you back again tomorrow.